Today I'm going to feature three people who will present views of mostly of the stock market, but the economy, the Fed, the stock market for 2023 and even into 2024. I'm going to begin with Felix Zuloff from Switzerland, and then Aaron Brown from PIMCO, interviewed by David Weston on Bloomberg, and Mohamed El-Erian, interviewed by Becky Quick on CNBC. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is February 7th, 2023. Thank you for watching. Let's begin with Felix Zuloff. Felix Zuloff has been around for a long time, for decades. He is not a household name in the US. However, he is extremely well thought of in Europe and those in financial circles. He's a private person and doesn't seek publicity or TV time. If he did, and particularly if he were in the US, I'm sure that he would be on the TV quite a bit. But he prefers more of a private life. He sold off his company. He built it up into the billions and sold it off, and now just manages family money with a small staff of people. What's interesting about him is that his insights are so spot on, and they have historically proven to be very accurate. So his prediction of market cycles have played out with just a lot of accuracy. And has a worldview, so he looks at things from more of a global macro perspective. So I'm going to play just a minute and a half from him, just on the stock market, and but the video itself encompassed a lot about the economy and the world and so forth. I'll comment a little bit on that after he finishes. But anyway, I'll let you take a listen to him speaking from Switzerland for about a minute and a half. Here's Felix Zuloff.
So I think the equity markets that I have been bearish on for about a year now will hit the low sometimes in early 23, probably late first quarter, I would say, where larger trading cycles bottom. And then we have a credit event or something like that, a trigger that signals to the central banks around the world that they should ease up, that too much damage is being created out there in the world. And then I expect a change in monetary policy by the leading central banks. And that should really open the door for a better 23 for financial assets. I think bond yields have probably an open window for 6, maximum 9 months to decline. And equities will probably rally into 24 and commodities probably even into 25. So I'm warming up to a major market bottom or a cyclical market bottom, and a better environment for 23 for investors. So my message is actually some pain, short-term pain first, but bigger gains later, and good outlook in 23 into 24.
The cycles that Felix Zuloff is talking about have been echoed by other videos that I've played, particularly I think of the ones I've played from Mike Wilson from Morgan Stanley. They all have kind of a similar outlook and time frame. They are saying that the market is likely, the market, not the economy, but the market is likely to struggle and decline during the first half of 2023. It's hard with predictions to be precise. So if you said the latter part of the first quarter or into the second quarter, and you just said sometime during the first half, that would be fairly accurate. And they're all saying that. And I'm going to play a couple of more that'll say the same thing. But then some kind of a rally, some kind of an acceleration from the market, because it's going to be oversold, rallying into or increasing in value toward the end of the year. So, and then he points out that there will likely be a mild recession, meaning 2 quarters of economic contraction during the middle part of 2023. Say second and third quarter is about as precise as he can be. But, and then there's others who say a recession toward the second half of the year. Any of that, if either one of those happen, that's a pretty good prediction. Next, I want to play a video from David Weston, who's interviewing Erin Brown from PIMCO. And again, she points out some of these same things, that the, a period of contraction and then expansion into the latter part of the year. Take a listen to Erin Brown.
Erin, I'll start with you. This was a very busy week. The markets were not always clear about what they thought. What did you make of what happened over the course of the week, and particularly those jobs numbers?
I think that the jobs numbers came well above consensus expectations and certainly underpinned the fact that the economy is not in a recession right now, that job growth still remains quite strong and the labor market is still quite tight. And it probably also underscores the fact that the Fed has more work to do with respect to keeping rates in restrictive territory. The Fed has already indicated that they'll likely hike in at least an additional one time in March. And then after that, I think, certainly there's scope for the Fed to potentially hike an additional one time or pause there. But in either case, the Fed will likely not cut rates for an extended period, continue to remain restrictive for quite some time, and then really observe and see how the data unfolds from there. And so while the market has been romancing this idea of the Federal Reserve starting to cut at the tail end of 2023, the Federal Reserve, at least for now, is likely to continue to keep rates on hold for an extended period of time and not meet the market's expectations for rate hikes as soon as the market is expecting.
Again, Erin Brown is echoing the same thoughts as Felix Zuloff, contraction during the next quarter or two, and then growth during the latter part of the year. Next, I want to play a piece from Becky Quick at CNBC is interviewing Mohamed El-Erian. And the reason I show him so much is because he's extremely insightful, different than most others, and usually spot on. So take a listen to the video from Becky Quick and Mohamed El-Erian.
Joining us now for more on the markets is Mohamed El-Erian, Allianz and Gramercy advisor and president of Queen's College, Cambridge. And Mohamed, looking at what Larry Summers had to say earlier, he said that this may be the most complicated economy he's ever had to try and read. Where do you come down on that? The jobs number on Friday really surprised a lot of people.
So he's absolutely right. And something that we have discussed on many Mondays is that we have significant uncertainty on 3 key issues. One is the way the economy functions. We can talk and defend many different outlooks for the real economy over the course of the year. 2, inflation. I can think of 3 possible scenarios for inflation. And then finally, policy and the disagreement between the markets and the Fed. So there is an unusual level of uncertainty, and then it feeds on to the structural uncertainty we've been talking about. The energy transition, the rewiring of supply chains, the change in globalization. So I completely agree with Larry. It is a very difficult economy to read, and we have to get our head around the notion that there are many potential outcomes, and no one can convince you with a high level of conviction and foundation that one will prevail. We just don't know, Becky.
So what do you do? Where are you going to throw your hat?
So first, if you're a portfolio manager, and it goes back to something you discussed in the 7 o'clock hour, you think a lot more about the tails. You don't ignore the tails as thin and very unlikely. You think a lot more about the tail. You don't just position yourself for the baseline because the baseline is less probable. As an economist, you take a lot of time going through the data in major details, because that is what's going to show you. I think the service sector is probably the most important sector to understand today.
Okay. In terms of what you think the Fed is going to do, how much more complicated did it just get? I mean, Jay Powell was sounding a little dovish last week before we got these jobs numbers, but you look at the jobs number, my guess is they're game on again in terms of higher rates.
Yeah, you know, he said disinflation 11 times during the press conference, 11 times. That word wasn't mentioned a single time by the ECB president or the governor of the Bank of England, who spoke the following day. And he gave the market the perception of a hard turn towards soft landing, and then we got the Friday report. So he's going to have to decide whether he wants to clarify tomorrow where he sees things going. Look, you know that I would have preferred that they do 50 basis points and then wait and see. They didn't. I suspect we have 2 more 25 basis points ahead of us. And my major concern is the possibility that they end up hiking into a weakening economy. The economy is very strong now, and that's why you wanted to get the hikes out of the way. I worry that we may end up hiking into a weakening economy, and that would be unfortunate.
Dr. El-Erian points out that, again, the Fed has painted themselves into the corner, and they are boxed in, and it looks like they now have to raise rates. He commented a week or two ago that this last meeting that they had, that they should have raised rates 50 basis points, and they didn't. They raised it 25, and then followed that followed a hot jobs report came out on Friday, way higher than was expected, which means, again, the Fed is behind the 8 ball and has to raise rates to cool off the hot inflation, which is comprised of several sectors, but the one sector that's holding inflation up quite a bit is wages. And the higher the jobs, I'll get into this later, but the higher the employment, that's good for people looking for jobs. It's good in one sense for the economy, but from the Federal Reserve standpoint, and they're trying to calm inflation down, it means they have to become even more aggressive on the rate hikes. So it's sort of which is going to probably, I won't say crash the economy, but certainly slow it down. So it's kind of a mixed blessing there. Okay, I want to get into several things related to the economy, and I'm going to start with debt, credit card debt, consumer debt. The debt, I saw this article, the consumer debt, credit card debt has risen 18.5% to $930 billion in 1 year. So that's an increase of, it's nearly $1 trillion of credit card debt. This is a slide that shows some details, some metrics around it. So the credit card balances have gone from $785 billion to $930 billion. The number of credit cards went from 485 million credit cards to 518 million, an increase of about 30 million credit cards in 1 year. The number of HELOC organizations, the number of HELOC originations, those that originate a home equity loan, and it's called a HELOC. And that has gone from 286,000 to 405,000 a year later. And then the total unsecured personal loan balances from 167 billion to 222 billion. Huge increase. So what that does is it puts a weight, an anchor on the consumer, and therefore it puts a weight on the economy. So the ability for the consumer, the elasticity for them to be able to go out and spend discretionary dollars is less. So that means there's probably going to be more contraction and to move these into more savings rather than more debt. Robert Shiller, professor of economics at Yale and Nobel Prize winner, does a number of things. He's known for his housing index, but he also does a historical PE ratio, and that is charted. It's called the Shiller PE ratio. And this goes way back over a long period of time up until currently. So this is from 1880, 1870 to present. And so it's a macro chart, but it's very interesting, and I'm going to break this down a little bit more. The PE ratio, it ends, so when you look at the very end of the chart, you can see it comes down a little bit. And that's still that the end of that line at the very far right of the chart, the PE for the S&P 500 is 30 to 1. $30 of price for every dollar of earnings. Historically, you can see where that has been, both up and down, a lot. But 30 is a very high number. The mean is 17 to 1. The median is 15 to 1. The highest number is 44, and the lowest is 4. So if you just target that mean number at 17 to 1, you can see how elevated we are still at 30 to 1 compared to just the mean. So this is a chart or some data. It's broken down into deciles, and it shows that when we are in a very elevated PE ratio where we are today, today's number at 30 to 1 puts us in the first decile, the top 10% historically, going all the way back to 1909. So this data is not taken from the previous chart. This is another set of data taken from Crestmont Research. So the more elevated the PE, what that means is that it needs to revert to the mean. It needs to come down. And as such, this data shows that over the following 10 years, when the PE is in the top decile, the top 10%, that over the next 10 years, there is historically been for, 110, 115 years, there's historically been a very low rate of return for the S&P 500 index, going from a range for the next 10 years averaging a minus 1.8% to a positive 3.6%, with an average of 1.3% per year. So what that spells to us is where we are today, as you look out over the next 10 years, the average rate of return for the S&P based on historical patterns is likely to be very, very low and probably minimal to zero. So where we want to be is in the higher deciles, which are toward the bottom, where the PE ratio is not so elevated. Then the opportunity to make money or to have the S&P 500 index make money and have gains over the coming 10-year period is more favorable because it's not starting out at such a lofty number. Last Friday, the non-farm payrolls came out. And again, like I said, this is good news, but it didn't spell good news for the market. So the good news is that 500,000 people more became employed. And so the expectation was that 188,000 were going to become employed. So this was more than double what was expected. So that's represented by that red bar on the right. But from that, the market tanked because it spells that the Fed has got to be, Chairman Powell said, gave a very positive tone that they were going to ease up. And Mohamed El-Erian said they used the word disinflation 11 times. But the following day, or a couple of days, this came out and kind of threw cold water on his comments. Again, I think they said very nicely, I think he got it wrong again. Okay, this is a graph showing the spike down. This is the impact that COVID had. When during the pandemic, the people who got laid off just dropped like a rock, literally. And then from that second quarter of 2020, you can see the rise in employment. It has continued to go up, including today. This is showing the number of people employed, not unemployed. So those that are employed are in the U.S. economy today about 155 million. But look where we came from. That was a big drop and a big surge up. This is interesting. When they come out with a report on payroll or on any economic indicator, they say, here's the number, and then next month they adjust it based on data that came in. And this shows the number that came out, which is the yellow line below, and then the revision, it looks like it always went up. So the revised number, when the data got finally flushed out, continues to outperform the data that was initially reported. I thought that was an interesting gap. Now I'm going to flip this around and look not at employment, but the other side of the coin, unemployment. You may remember that during COVID, right, during that second quarter of 2020, that unemployment went up, just spiked up to 12%. Then it came down very sharply. And you can see that by this spike on the far right of the chart. Today, unemployment is at 3.4%. They projected it was going to be 3.6, but it came in at 3.4. So employment at that level, and you can see historically going all the way back to 1969, it's never been that low. So this is a historical, very, very low unemployment, a very full employment economy. And in one sense, you could say it's actually a very strong economy. I think Mohamed El-Erian said that. So this is making it challenging for the Fed because they've got to, and what this causes, it causes inflation on wages because people are having to pay up to get employees. And so to get inflation down to the 2% level, which is their target, it means that the employment component, the labor component of the consumer price index has probably got to get down around 3%. So if it's at 3, from an inflation standpoint, that's a long ways from where it is now. So this creates a challenge for the Fed. So expect more rate hikes. I would say March, May, and probably June, perhaps. We're going to see rate increases from the Fed. So they've got to put the brakes on the economy to slow it down, and particularly to slow wage inflation down. Conversely, this is interesting. So we talk about full employment. Over in the tech industry, they're laying off people. So this chart shows that during this past year, this is a month-by-month chart, and you can see the elevation is going up, that during the past year, 218,000 people in the tech industry have been laid off. And that's going on while the rest of the economy is experiencing, in a lot of industries, are experiencing shortages. So maybe they can get together here. I don't think the rest of the economy is going to pay the wages that these people made, but the tech industry, the employees, those companies were very bloated. I think with Elon Musk and Twitter, I think he laid off, I think it was like 80% of the workforce, and because they had a loss of revenue, loss of ad revenue, And I think that, and they continued to function. And so what's interesting is Twitter's still around. They're still doing business with 20% of the employees. So how much of that 80% was needed? So I think a lot of that gave permission to a lot of the tech companies, Facebook, Google, Microsoft, et cetera, to lay off workers. And they did. So maybe kind of right-sizing that industry. And I'm not making a statement for or against the tech industry. It's just, it tells me it was probably fairly bloated. I would assume that they drew that same conclusion. Here's, just a snapshot of, the companies who laid off a lot of people. While this is going on, and this is helping the consumer price index come down, the price of gasoline / the price of crude oil is dropping. I won't say dropping like a rock, but it's dropping a lot. So you can see from the far right, the right side of the chart, where crude oil prices are, and they are at $79 a barrel in a fairly short period of time. So what was it? Last month they were, pretty lofty and have come down very quickly. So that's a good thing. Now I want to get into the flow of funds report. This is it's interesting to me that this is showing kind of if you use this as an indicator, kind of a flight to safety for money. It's moving in a safer place, safer component, considering stocks to be more risk assets and bonds and money market to be less risk. It's moving in that direction. So for the week ending January 25th, there was an outflow of $4.3 billion out of equity funds, an inflow of $7.5 billion into bonds, and an inflow of $4.8 billion into money market funds. No more tightening, Jay, the bull says. So Chairman Powell is, as they say, putting the screws to the bulls with his rate increases. Thank you for watching. If you have comments, leave them in the comment section below, and I will try to answer them.